Hello and welcome to this video of Inside Stream. I'm your host Dr. Manmohan Radheshyam Yadav, and this is the very first video of the year 2026. In this stream, I intend to conduct a forensic breakdown of a coordinated financial surgical strike that was undertaken against silver last week on 29th and 30th of February. Today is Tuesday, 4th of February 2026. The smoke is clearing, the casualties are being counted, and the evidence of what just happened is undeniable. We are going to walk through the crime scene step by step. We will look at the weapon, the motive, and we are going to show you the fingerprints left behind by the most sophisticated takedown operation in the modern commodity market history. Let me give you the headline number that defines the battlefield. As of 4:30 Eastern Standard Time, 2nd February, silver was trading at a bid price of $79.89 per ounce on Kitco. The ask price is $80. That represents a catastrophic single session collapse of $6. In percentage terms, that is a drop of 7.46%. To put that into perspective, the intraday low during the carnage touched at $77.53 US. The intraday high before the hammer came down was $84.18 US. That is a swing of nearly $7 in a span of hours. Now, if you are a casual investor, if you just glanced at the chart this morning and saw red, you probably thought that this was a normal correction. It's wrong. This was not a correction, it was a surgical strike. This was planned demolition, and the blueprint for how it was executed is sitting in plain sight, if you know where to look. Gold did not escape either. Gold crashed to $4,672 per ounce on the bid. That is down $216.80 US, a loss of 4.43%. Gold hit a low of $4,444. The high before the collapse was $4,845. My apologies, was $4,885 US, nearly $500 of volatility in a single trading window. When both gold and silver move in a lockstep like this, when they both get crushed at the same moment with the exact same ferocity, that is not a market. That is a message. Someone just sent a warning shot across the bow of every bullion holder in the world. The question is, who fired it, and the most importantly, why did they fire it? Now, before we identify the shooter, we need to understand the terrain. Because the crash you saw on the screen did not happen in isolation. It happened on top of the most extreme price run in silver's modern history. Let me take you back 6 months. 6 months ago, silver was trading at a low of $60 US per ounce. It was boring, it was stable. Then something changed. The buying started. Not retail buying, not small speculators, institutional buying. Central banks buying, the kind of buying that moves hundreds of thousands of ounces per day. Silver started climbing. Then we broke $100 US. We briefly touched $121 US. That was all-time intraday high. It was the peak of the mountain, and that is exactly when these institutions detonated the explosives. We must understand what $121 US means. That price level represents an existential threat to the legacy financial systems in the Western world. At $121 US, the paper contracts written by the bullion banks, the synthetic drivers that promise to deliver metal that does not exist, those contracts go underwater. The short position holders start bleeding money, the clearinghouses start sweating, the margin calls start flying. At $121 US, the game is over for these legacy financial institutions. The jig is up. The Ponzi scheme collapses, so they could not let it stay there. They had to knock it down, and they had to do it fast, hard, and with enough violence to scare every retail buyer into selling. That is what you witnessed last week. That is the crash, but the crash is just a symptom. The disease is what happened behind the curtain while the price was falling. The crash began simultaneously on two exchanges that should never move in perfect synchronization. The first exchange was the COMEX in New York. The second exchange was the Shanghai Futures Exchange in China. These are two modern markets separated by 7,000 miles, 12 time zones, and completely different regulatory regimes. They do not share the same clearing houses, they do not share same participants, and yet at the exact same moment, both markets experienced massive selling pressures. Both markets saw enormous contracts dumped into the bid. Both markets saw liquidity evaporate. The price in New York tanked. The price in Shanghai tanked. They moved as one. That is statistically impossible unless the selling was coordinated, unless the same entity or group of entities was operating on both sides of the planet at the same time with the same objective: to crash the price, to kill the momentum, and to break the backs of the small time investors and daily traders. Now, one might be asking, who has the power to do that? Who has the resources to manipulate two of the largest commodity exchanges on earth simultaneously? There are only three entities capable of pulling an operation of this scale. The first is the US Federal Reserve and its primary dealer banks, JP Morgan and Goldman Sachs. They have the capital, they have the infrastructure, and they have the motive, because soaring silver prices exposes the weakness of the dollar. The second entity is the People's Bank of China and the state-owned enterprises that execute its commands. China has been stockpiling silver for years. They have the inventory, they have the motive to control the price discovery, and they have the geopolitical incentive to destabilize Western commodity markets. The third entity is the collaboration between the two, a coordinated attack where both sides benefit. The Federal Reserve gets to suppress the price to protect the dollar. The Chinese get to buy the dip and accumulate more metal at a discount. This is a nightmare scenario that is World War playing out in real time on the trading screens. The evidence for coordination is not just in the timing, it is also the mechanics. Look at the weapons they have used. The weapon is known as the margin hike. It is the nuclear option of commodity exchanges, and here is how it operates. When you trade future contracts, you do not pay the full price upfront. You post a margin amount, a kind of down payment that acts as a collateral. Normally, the margin is set at reasonable levels to allow traders to use leverage and provide liquidity to the markets. But the exchanges have the authority to change the margin requirements at any time. They can raise it, they can double it, they can triple it overnight with zero warning. And when they do, every trader holding a position suddenly needs to wire millions of US dollars in the additional cash to keep their contracts alive. If they do not have the cash, they are forced to sell. The forced liquidation, that is the weapon. And that weapon was just utilized. The COMEX raised margin requirements on silver futures to levels that are nothing short of confiscatory. We are talking about numbers that make it prohibitively expensive for anyone except the largest institutional players to hold a position. At the same time, whispers are circulating at the Shanghai implemented simpler measures. Though the Chinese market operates with far less transparency, so it cannot be confirmed, but the effect was identical. The traders on both exchanges were forced to liquidate. They had no choice, either to sell or get wiped out. And when the thousands of contracts hit the market at once, the prices collapsed. This is not supply and demand, this is forced capitulation. That is market manipulation disguised as risk management. But here is why it gets diabolical. While the margin hikes were crushing the speculative long positions, the same banks that benefit from lower prices were waiting on the other side of the trade. They were the buyers. They were scooping up the contracts at 79 US dollars that were worth 93 US dollars just days earlier. They engineered the crash and then they profited from it. They shook the tree and they collected the apples. This is the playbook. This is how they have suppressed silver for decades. But this time, The violence of the move is so extreme, the coordination so balanced, that even mainstream analysts are asking the question. Even the people who usually defend the system are starting to admit that something does not smell right. Now, let us take a look at the narrative. Let me tell you the lie that they are going to spin to justify this massacre. They are going to say it was a healthy correction. They are going to say that the market was overheated. They may state, they may bring out analysts on the CNBC and Bloomberg networks who will calmly explain that after such a rapid rise, a pullback was inevitable. They will use phrases like profit taking and technical retracement. They will make it sound rational. They will make it sound normal. But this was not profit taking. It was panic inducing. This was a coordinated assault designed to shake out the positions of the small time investors and daily traders before the real move in silver prices start. Because the fundamentals that drove silver to 121 US dollars have not changed. Industrial demand is still exploding. The solar panel production is still ramping up. The electric vehicle manufacturing is still consuming record amounts of silver. The supply deficit is still widening. None of that has changed. The only thing that has changed is the paper price. And the paper price is a lie. When the future prices on the COMEX were getting demolished, the physical markets were doing something completely different. The bullion dealers are reporting premiums over the spot prices. The extra amount that you have to pay to actually take delivery of the physical metal have risen. In some cases, the premiums have doubled. In some regions, you cannot even find silver at any prices. The wholesalers are out of stock. The refiners are backlogged. The mints are running at full capacity and still cannot keep up with the demand. So, how can the prices be crashing while the metal is in such high demand all over the world? How can silver be in a free fall on the screen while the dealers are raising premium prices and turning away customers? The answer is simple. The screen is lying. The futures market is a fictional construct designed to suppress the price of an asset that the world desperately needs, but the system desperately fears. This brings us to the question that will determine the financial future of millions of investors in the silver commodity. Do you trust the paper price, or do you trust the physical reality of the markets? The disconnect between the paper and the physical cannot last forever. One of the two things are going to happen. Either the paper price will gap up violently to match the physical scarcity, or the paper market will collapse entirely and the physical will trade in a separate universe at multiples of current quote. Let me give you the industrial catalyst that guarantees that silver goes higher regardless of what banks do to the future markets. Starting with the solar energy. The world is in the middle of green energy transition. Governments all over the world have committed trillions of dollars to decarbonization. That means solar panels, lots of them, and every single solar panel requires silver. The photovoltaic cells that convert sunlight into electricity are built with silver paste. There is no substitute. You cannot make a solar panel without silver. The amount of silver required per panel is not a small one. The International Energy Agency estimates that solar installations will consume over 200 million ounces of silver per year by the year 2030. That is more than 25% of the global mine supply. Think about what that means for the supply equation. Global silver mine production runs at approximately 800 million ounces per year. The number has been relatively flat for the last decade. Mining companies are not finding new deposits fast enough to replace the depleting reserves. The easy silver has already been mined. What is left requires deeper drilling, more complex extraction, higher costs, and meanwhile the demand is accelerating. Solar panels alone are not going to eat up a quarter of the total supply, are going to eat up a total of quarter of total supply within 4 years, and that is just solar. That does not include electric vehicles, which uses silver in battery connectors and charging infrastructure. A single electric vehicle contains anywhere between 25 to 50 grams of silver. depending upon the model. Global electric vehicle production is projected to hit 20 million units by the year 2028. This means another 15 million ounces of annual demand just from cars. That does not include 5G networks, which use silver, and circuit boards and antennas, which also require silver. Every cell tower, every base station, every relay node contains silver components. The build out of 5G infrastructure globally represents tens of millions of ounces of incremental demand for silver. That does not include medical devices which use silver for its antimicrobial properties. Silver is used in wounds dressings, surgical instruments, and water purification systems. Other than that, it is also an essential component of electronics manufacturing, where silver is the conductor of choice for high performance applications. The industrial demand alone is enough to create a structural deficit in the supply of silver. Add to it investment demand and the central banks accumulating all over the world, and you have a recipe for a price explosion that no amount of margin hikes can stop. But here is the critical point: industrial users do not trade on margins, they do not speculate, they are not momentum chasers. They are cash buyers who need the metal to keep their factories running. When a solar panel manufacturer places an order for 10,000 ounces of silver, they pay the full price upfront and they take the delivery. They are not deterred by a 7% price drop. In fact, they view it as a buying opportunity. They accelerate their purchases, they lock in the supply before the price rebounds. Every time the paper price gets smashed, industrial buyers step in and remove the metal from the system. The available supply shrinks, the next rally starts from a higher base. The banks can suppress the future prices, but they cannot suppress the drain on physical inventory. The vault levels keep falling, the registered ounces keep declining, and eventually the system runs dry. But the industrial story is only half of the equation. The other half is monetary. Silver is not just a commodity, it is money. It has been money for almost 5,000 years. And when fiat currencies collapse, when dollar loses its reserve status, when inflation spirals out of control, people flee to silver. They always have, they always will. And right now, dollar is in free fall. The dollar index is plummeting, the US national debt is accelerating, and it has gone past 36 trillion US dollars. The Federal Reserve is trapped between inflation and recession. They cannot raise rates without crashing the economy. They cannot lower rates without destroying the currency. They are out of options, and when central banks are out of options, hard assets win. Silver wins, gold wins, real things win. Paper always loses. The dollar index, which measures the US dollar strength against a basket of foreign currencies, has been in a structural decline for months. It is not a blip, it is not a temporary dip. It is a systematic unraveling of confidence in the world's reserve currency. Foreign central banks are diversifying their reserves. They are selling treasuries, they are buying gold, they are buying silver. They are reducing their dollar exposure because they see what is coming. They see the debt spiral, they see the political dysfunction, they see the inability of American policymakers to make hard choices. So they are getting out. At the same time, domestic inflation is eroding the purchasing power of every dollar in circulation. Official numbers in the United States say inflation is under control. The US government states that the rate of inflation is around 3%. But a common US citizen who buys groceries, anyone who pays rent, anyone who fills up a gas tank knows the truth. Real inflation, the inflation that a US citizen feels in the daily life, is running in double digits. Adjusted for the loss of purchasing power, financially, the US common citizen is going backwards. The only way to escape the trap is to own assets that cannot be printed, assets with intrinsic value, assets that have stood the test of time and have acted as stores of wealth. That is silver, that is gold, that is real estate, that is hard commodities. Everything else is a claim on a system that is collapsing in a slow motion. The US national debt is another ticking time bomb. The US government just crossed 36 trillion, a trillion with a T. The interest payments alone are now consuming over 1 trillion US dollars per year. That is more than the entire US defense budget. Americans are borrowing money just to pay the interest on the money they have already borrowed. That is the definition of a debt spiral. And there is no political will to stop it. Neither of the parties are serious about cutting spending. Neither party is serious about raising taxes. They are both committed to the same strategy. Borrow more, print more, kick the can down the road, and hope that the system holds together for one more election cycle. But the hope is not a strategy. Maths is maths. And the math says that this ends in a default or devaluation. Either the government defaults on its obligations, which would trigger a global financial crisis, or the Federal Reserve prints enough money to inflate away the debt, which would trigger hyperinflation and destroy the US currency. In either of the scenarios, it is catastrophic for anyone holding physical US dollars. Entire scenario is bullish for silver. This is why the coordinated takedown is so telling. This is why the violence of the move is actually bullish. The fact that they had to use margin hike, the fact that they had to coordinate across continents, the fact that they had to smash the price with such force, it tells you that they are desperate. They are fighting a losing battle. They know that the fundamentals are against them. They know that the physical market is draining away the metal. They know that every day they keep the price suppressed. More metal flows towards Asia and less metal stays in the Western vaults. They are playing for time, but the time is running out. So what could happen next? In the short term, the silver price is going to be very volatile. The banks are going to try to keep it pinned below 80 US dollars. They are going to paint the charts red. They are going to try to scare away the small time investors, the household investors, but the physical buyers are not going away. The Chinese are not going away. The Indian household investors are not going away. The industrial consumers are not going away. They are going to keep buying, and every time the banks push the prices down, they are going to buy more. This creates a floor that rises over time. Eventually, the banks run out of metal to sell. The vaults empty, the contracts become due, and the exchange faces a choice: default or deliver. If they default, the entire futures market loses credibility. If they want to deliver, they have to source the metal at any price, which means the prices skyrocket. Either way, the end game is the same. Silver reprices higher, higher, much higher. So what can we expect to see in the coming weeks? Over the next 2 to 3 weeks, we are going to see continued attempts to suppress the silver paper price. The banks will use every tool at their disposal: more margin hikes, more coordinated selling, more propaganda in financial media telling you that silver is overvalued and the silver rally is over. They have to convince as many retail holders as possible to sell their physical metal back into the markets so that the institutions can restock their vaults. They need inventory, they are desperate for inventory, and that is why premium prices are spiking. That is why the dealers are running low. The system is critically short of deliverable silver, and they need to shake it loose from weak hands before the situation becomes terminal. But here is what is not they are counting on. The new generation of silver buyers understands the game, if not willingly, if not consciously, but perhaps unconsciously. They have seen this movie before. They have watched the takedowns in the year 2013. They have watched the suppression of prices in 2020. They have studied the history of the Hunt brothers squeeze of 1980s. They know that every time silver gets knocked down, it eventually comes back stronger. They are not panic sellers. They are accumulation buyers. They view dips as opportunities. They are not trading, they are stacking. And you cannot shake out a stacker. A stacker does not have a stop loss. A stacker does not care about daily volatility. A stacker is a player who is playing an entirely different game. They are preparing for the day when the monetary system resets, and the only thing that matters are physical assets that are controlled. As we move into March and April, the pressure is going to build. The industrial buyers are going to need metal for the second quarter production. Solar manufacturers have orders to fulfill. The electronic components have to be built. These manufacturers cannot wait for the banks to sort out their short positions. They are going to bid aggressively for the physical metal. At the same time, the geopolitical situation is going to deteriorate even further. The tension between the United States and China are escalating. The trade wars are intensifying. Currency wars are heating up. Every nation is trying to protect its own interest, and in that environment, the hard assets become a strategic resource. Countries that control silver supplies will have leverage. Countries that do not will be vulnerable. We are entering an era where commodities are weapons, where supply chains are battlefield, where economic security depends on the resource independence. Silver is not just an investment anymore, it is a national security asset. By summer, I expect that we will see the first cracks in the derivatives market. A major institution will announce difficulty sourcing physical metal to meet delivery obligations. It might be a pension fund, it might be a sovereign wealth fund, it might be an industrial user, but someone is going to stand up and say that they cannot get the metal that they were promised. That announcement will trigger a crisis of confidence. On the other hand, the holders of paper contracts will rush to convert to physical, the exchanges will be overwhelmed, the silver prices will explode. And that is when the real rush to obtain silver begins. That is when the silver prices actually start moving. Thank you for listening for today's Insight Stream. I am your host, Dr. Manmohan Radhesham Yadav, and we will meet again. Thank you.